In parts of Miami-Dade County, housing prices continued to rise through 2023 and into 2024. During the same period, homeowners insurance became difficult to obtain. Some residents could not renew their policies. Others received renewal offers with premiums that had doubled or tripled in a single year. A few received no renewal offer at all. The housing market did not react to this. Prices kept climbing. Sales continued. Listings moved quickly. This created a situation that should not have been possible. A place became more expensive as it became harder to insure, harder to protect, and in some measurable sense, harder to live in. The contradiction was not subtle. It was documented in real estate data, insurance filings, and the quiet decisions of thousands of households. Yet it persisted. The market did not correct. Demand did not fall. Miami became more desirable as it became more exposed. This was not a temporary distortion. It was not a brief mismatch between supply and demand. It lasted through multiple quarters, across different neighborhoods, affecting both coastal properties and inland homes. The pattern held. Prices rose while protection disappeared. Risk increased while value climbed. Something fundamental had shifted in how housing markets responded to risk, or perhaps in who was expected to bear it. The story of Miami is the story of that shift. It is about what happens when the cost of living somewhere is separated from the cost of protecting yourself there, when those two numbers move in opposite directions, when a place becomes simultaneously more expensive and more dangerous to inhabit. Miami sits at the edge of the Atlantic, built on limestone and filled wetland. Much of Miami-Dade County lies only a few feet above sea level. Barrier islands stretch along the coast. Inland neighborhoods sit barely elevated. Water surrounds the city from multiple directions. Biscayne Bay to the east, the Everglades to the west. Canals run through residential blocks. During king tides, seawater rises through storm drains. Streets flood without rain. This is not failure of infrastructure. It is the result of geography. Miami was built in a place that floods naturally. For decades, this was managed. Pumps were installed, roads were raised, seawalls were reinforced. The city adapted continuously. But the environmental pressure did not remain constant. Storm patterns shifted, high tides reached higher, rain events became more intense, hurricane seasons grew more unpredictable. The ocean warmed. The atmospheric conditions that generate major storms occurred more frequently. Miami's physical reality changed incrementally, year by year, in ways that were measurable but not always visible. A seawall that was sufficient in 2005 was inadequate by 2020. A drainage system designed for historical rainfall struggled with new patterns. Coastal neighborhoods that rarely flooded began flooding regularly. This was not apocalyptic. It was gradual. It was the kind of change that can be ignored until it cannot. Miami remained beautiful. The beaches were still visited. The skyline continued to rise. Development moved forward. But beneath the visible city, the relationship between land and water was shifting. The margin for error was shrinking. The buffer that had always existed between normal conditions and dangerous conditions was narrowing. Miami was becoming a place where the infrastructure, the geography, and the weather were moving out of alignment, where the systems that had made dense coastal living possible were being tested in ways they were not designed for. The insurance industry noticed this before the housing market did. Companies that had operated in Florida for decades began to reassess their exposure. They examined claims data, they modeled storm scenarios, they calculated the probability of catastrophic losses. The numbers did not support continued coverage at previous rates. Some insurers raised premiums significantly. Others restricted coverage, excluding wind damage or flood damage from standard policies. A few stopped writing new policies in certain zip codes. Several withdrew from Florida entirely. This was not coordinated. It was not a conspiracy. It was a series of independent decisions made by companies responding to the same data. The risk had become unacceptable. The potential losses outweighed the premiums. In a purely financial sense, insuring homes in parts of Miami no longer made sense. Homeowners received letters, non-renewal notices, policy changes, premium increases that were not marginal but transformative. A policy that cost $2,000 one year might cost $5,000 or $6,000 the next. Some residents scrambled to find alternative coverage. They
They contacted brokers, they applied to smaller, less stable insurers, they sought quotes from the state-backed insurer of last resort, which had its own limitations and higher costs. Others simply went without coverage, accepting the risk or unable to afford protection. The market for insurance contracted while the housing market expanded. These were supposed to move together. Insurance availability was supposed to reflect livability. If a place became too risky to insure, it should become too risky to buy. But that connection broke. The signal that insurance was supposed to send, that living here carries real, quantifiable danger, was not received by the housing market, or it was received and ignored.
Residents experienced this as paperwork, as phone calls, as uncertainty spread across months. A homeowner would receive a non-renewal notice 60 days before their policy expired. They would call their insurer. They would be told the company was no longer offering coverage in their area. No explanation beyond that. No recourse. They would contact brokers. They would fill out applications. They would wait. Sometimes a new policy would come through, but with a premium that was double or triple what they had paid before. Sometimes coverage would be offered, but with exclusions that made it nearly useless. Wind damage excluded, flood damage excluded. The policy would cover fire, theft, liability, but not the risks that actually threatened the home. Some homeowners were forced into the state-backed Citizens Property Insurance Corporation, which was intended as a safety net, but had become the primary insurer for hundreds of thousands of Florida properties. Citizens had its own problems. It was underfunded relative to its exposure. Its premiums were rising. Its solvency depended on no major storms hitting Florida in quick succession. It was not a sustainable solution. It was a temporary buffer. For those who could not afford even Citizens, there was nothing. No legal requirement to carry insurance if the mortgage was paid off, no enforcement mechanism, just the choice to live unprotected or to leave. This produced a quiet, diffuse kind of stress, not dramatic, not visible from the outside, but constant, the knowledge that a storm could erase everything, that rebuilding would be impossible, that financial ruin was one weather event away. This stress did not register in housing prices. It did not affect demand. It existed in parallel to the market, felt by those who lived there, but not reflected in the transactions.